cash dividends. So one of the main reasons that we buy stock is because we hope that we're going to earn something on our investment. We want the stock to increase in value so we can sell it at a higher price than what we paid for it, and we hope to receive cash dividends while we're waiting for our stock to improve in value. In order for companies to pay cash dividends, they have to have retained earnings. They have to have an adequate cash amount in order to pay off the dividends, which means that they don't have any liabilities that they're not paying for. They have to be good on all of their debts and have current cash reserves. And then the board of directors has to formally declare a dividend. So we have 4 significant dates when we're looking at the distribution of a dividend. So the first one is the date of declaration. This is when the board says that they're going to pay a dividend. On this date, we create a liability that dividends are going to be paid. The second date is an ex-dividend date. This date decides when it's a date that's set for the trade that determines who does or doesn't get the dividend. So for example, if I sell my stock after the ex-dividend date, then I'm going to get the dividend. If I sell it before the ex-dividend date, then the new person who purchases my stock is going to receive the dividend. Then we have the date of record. So the date of record is usually right around that ex-dividend date. And this is the date at which they decide who receives that dividend. So we have to be on the record, on the corporation's record, as the owner of stock on that date of record. And then the fourth date is the date of payment. This is when the cash actually goes out the door from the corporation to the shareholders. So we're going to look at these examples. The first one we have on December 15th, the board of directors declares a $1 per share cash dividend on its 125,000 common shares outstanding. This dividend is payable to stockholders of record on January 10th and paid on January 25th. So first we're going to look at December 15th. On December 15th, when the board of directors declares they're going to pay a dividend, we need to record a liability. So on December 15th, we're going to record a journal entry. We're going to debit dividends for $125,000. That's $1 per share times our 125,000 shares. Then we're going to credit dividends payable for $125,000. Then our next date is the date of record for January 10th. Some days before the date of record, we'll have that ex-dividend date. There's no journal entry on the ex-dividend date or the date of record. So our next journal entry occurs on January 25th when we pay that dividend. So then on January 25th, we're going to credit our dividends payable for $125,000. And then we're going to credit our cash account for $125,000. Liquidating dividends happen if we create a dividend that is higher than the balance in our retained earnings account. This usually only occurs if we're going to go out of business or we're making a permanent reduction in the size of our operations. So we can assume that a dividend represents a distribution of profits unless we're notified by the corporation that the dividend is a return of invested capital. So we should just assume that our dividends are being paid out of retained earnings unless we are told otherwise. As a shareholder, you would want to know if it was a liquidating dividend or a normal cash dividend. A stock dividend is when instead of being paid cash, we're given more shares of stock. So this is if we're authorized to give out 500,000 shares of stock, and we currently only have 100,000 shares outstanding, then we could, instead of giving cash to our shareholders, we could just give them additional shares of stock. Sometimes a company does this if they haven't paid dividends in many, many years, but they don't really have the cash available to pay dividends, or they want to do something else with that cash, but they want to make their stockholders happy, so they're going to give them something in the way of like a consolation prize by giving them more stock for free, essentially. Then we've made them happy without doing cash. So when we're looking at cash dividends versus stock dividends, with our cash dividends, we have distribution of cash. We reduce the asset of cash, and we reduce our stockholders' equity by removing dividends from retained earnings. If we pay a stock dividend, we don't distribute anything. We have no change in the total assets, liabilities, or total stockholders' equity. What happens is that we receive additional shares, but we don't change our percentage in ownership. And it also affects the book value of the stock. So when we look at recording stock dividends, there are two different effects. One is for a small stock dividend. So if we're recording a small stock dividend, then we're going to use the market value of the new shares. We transfer that amount from retained earnings to the paid-in capital account. The overall effect on stockholders' equity is the same as if the dividend had been paid in cash, and then we immediately reinvest that back into the business in exchange for additional shares of stock. If we have a large stock dividend, the treatment of that is different. But let's look at a small stock dividend. So on June 1st, we have 100,000 shares outstanding, $5 par value common stock, and a market value of $25 per share. We've declared a 10% stock dividend that we're going to distribute on July 15th to any stockholders of record on June 20th. On June 1st, we need to record the declaration of this dividend. So the first thing that we're going to do is that we're going to remove $250,000 from retained earnings. So 10% of 100,000 shares is 10,000 shares. At our market value of $25 per share, that totals $250,000. Then we have our stock dividend to be distributed. Now this is our 10,000 shares at their par value. This problem tells us that we have a $5 par value. So we take our 10,000 shares times a $5 par value, and that entry is $50,000. The rest we put into additional paid-in capital. And that is the remaining $200,000 that balances out that journal entry. So as I said before, the reasons for stock dividends are generally to give shareholders something of value while keeping their cash for other reasons. Another reason is because if we do small stock dividends, we don't really change the market price of our stock too much, and that dividend is not subject to income taxes unless the shares received are sold. And then it's individual income taxes and not taxes on the corporation. We're going to save stock splits for the next video.